Welcome everyone to week 2 of FIN4424 Case Studies in Finance. I'm Dr. Mark Dennis, your instructor for this course. You should all have my contact information by now, but it's here on the screen again for easy reference. Be sure to contact me anytime you might be late with turning in an assignment, or if you just need some help understanding a particular concept. In this session, we're starting part 1 of this week's live chat. We'll be diving into a case study that I think will not only reinforce some key financial concepts, but will also build on your analytical skills. Let's get started. We will begin by focusing on case 6 from the course materials titled The Financial Detective 2016. In this case, we'll analyze financial data to help uncover some critical insights about different companies. This exercise will help you understand how financial ratios can tell a story about a business and its performance. Our objective for this case study is straightforward but impactful. You'll be given financial data and ratios for 8 pairs of companies, and your job is to use ratio analysis to compare and contrast a single pair of these mystery companies with a single specific industry group. Your task is to select one pair of companies and only one pair, then analyze key financial metrics. At a minimum, you must explain and calculate for each company in your selected pair the following ratios: gross margin, inventory turnover, net profit margin, and at least 3 additional financial ratios of your choice. This will provide a comprehensive picture of each company's performance and its financial health. Tip: after selecting your industry and company pair, make a brief discussion post to let your classmates know your choice. Try to select a pair that no one else has chosen to reduce the repetition in the discussion. Depending on the size of our class, there may be some duplicates, but let's do our best to minimize those. Let's begin with gross margin, a fundamental financial metric. Gross margin tells us the percentage of revenue that remains after deducting the cost of goods sold, sometimes referred to simply as COGS, or direct expenses. Essentially, it shows how much money a company retains from each dollar of revenue after paying for the production of its goods or services. The formula for is simple. Gross margin equals revenue minus cost of goods sold, all divided by revenue. You then multiply this by 100 to get a percentage. A higher gross margin indicates a company is more efficient in managing its production costs. Now let's walk through an example of how to calculate gross margin using a sample income statement from ABC Manufacturing. Start with the revenue and cost of goods sold. As you can see in the table, ABC Manufacturing has revenue or sales of $500,000. This figure represents the total sales income generated by the company during a specific period. Below revenue, you'll find the cost of goods sold, which is $300,000. Cost of goods sold includes all direct costs associated with producing or purchasing the goods that were sold. Calculating gross profit. To find the gross profit, subtract the cost of goods sold from the revenue. In this case, $500,000 in revenue minus $300,000 in cost of goods sold equals $200,000 gross profit. This calculation tells us that ABC Manufacturing retained $200,000 from its sales after accounting for the cost of producing those goods. Calculating gross margin. The gross margin is a percentage that shows how efficiently a company generates profit from its sales. It is calculated by dividing the gross profit by revenue. Gross margin equals gross profit over revenue times 100, or in this case, 200,000 divided by 500,000 equals 0.4 or 40%. This result means that for every dollar of revenue generated, 40 cents contributed to covering other expenses and generating the profit. Interpreting the gross margin. A 40% gross margin indicates that ABC Manufacturing is able to retain 40% of its sales revenue after covering the direct costs of production. This is a healthy margin for many industries, but it's important to compare this percentage to industry averages and the company's own trends over time for better context. Why does gross margin matter? Gross margin is a key indicator of a company's financial health and its operational efficiency. A higher gross margin often means a company is effectively managing its production costs relative to its sales. Conversely, a lower margin may suggest the company has high production costs or it struggles to price its products profitably. Make sure that you understand where to find these figures on the income statement and how to perform these calculations. This example breaks down the process clearly, but it's also important to look at gross margin in the context of industry standards and the company's historical performance in order to draw meaningful conclusions. Next, we have the inventory turnover ratio. This ratio gives us a sense of how effectively a company manages its inventory. It is calculated by dividing the cost of goods sold by the total or average inventory. A high turnover ratio typically suggests that a company is efficiently selling its inventory, while a low turnover might indicate overstocking or poor sales performance. It's a valuable metric to evaluate a company's operational efficiency. Introduction to industry comparison. In this slide, let's highlight how the inventory turnover ratio can vary significantly between industries. We will compare two very different sectors, retail and manufacturing. First, let's look at a retail company called Supermart. Retailers tend to have high turnover ratios, and in this example, Supermart has a cost of goods sold of $500,000 and an average inventory of $50,000. By dividing the cost of goods sold by the average inventory, we get an inventory turnover ratio of 10 times. This means Supermart completely sells and replaces its inventory 10 times a year. High turnover is common for retailers because they often deal with perishable goods, seasonable products, or fast-moving consumer items. Next, let's shift to manufacturing. Carco Manufacturing has a cost of goods sold of $1.2 million and an average inventory of $400,000, resulting in an inventory turnover ratio of 3 times. This lower turnover is typical for manufacturers because their products generally have longer production cycles and they often hold larger inventories of raw materials or finished goods. To visualize this, you can clearly see that the retail company has a much faster inventory movement compared to the manufacturing company. Why does this matter? This example illustrates that a good inventory turnover ratio depends on the context of the industry. A high turnover ratio might be expected in retail, but the same ratio could be considered unreasonably high in manufacturing, suggesting potential stock shortages or over-aggressive inventory management. When analyzing inventory turnover, always consider the nature of the business. What may be efficient for one industry might be inefficient for another. Understanding this context will improve your ability to interpret and compare financial ratios effectively. Next, we consider one of the fundamental metrics in financial analysis, the net profit margin. This measure is a clear indicator of a company's profitability, representing what percentage of revenue is converted into net income. In essence, it tells us how much profit each dollar of sales generates after all expenses are paid. The net profit, also known as net income, is calculated by subtracting all expenses, including operating costs, interest, taxes, and other expenses, from the company's total revenue. It's the amount of money that remains after all the costs of doing business have been accounted for. Let's break down the formula for net profit margin. Net profit margin equals the net profit divided by total revenue multiplied by 100. To calculate the net profit margin, we take our net profit and divide it by the total revenue. We then multiply this figure by 100 to express it as a percentage. This percentage reflects the efficiency of a company in terms of profitability. For example, if a company has a net profit margin of 15%, this means that for every dollar of revenue made, 15 cents is net income. Understanding the net profit margin gives us deeper insights into a company's operational efficiency. A higher net profit margin indicates a more profitable company that has better control over its costs compared to its competitors. The net profit margin can also inform strategic decisions. For instance, if the margin is low, a company may look into reducing costs or increasing prices. If the margin is high, the company may consider expanding its operations or investing in innovation. Keep in mind, the net profit margin is a relative measure. It's most informative when compared to previous periods of the company's performance or against competitors in the same industry. Fluctuations in this margin can often signal changes in operational efficiency, cost control, and overall strategy. To help you succeed in your financial analysis and case studies, here's a compilation of some helpful resources. Let's quickly go over each of them. Use textbooks from previous finance courses. If you've taken prior finance courses, you likely have textbooks or digital materials that cover foundational concepts like financial ratios and analysis techniques. Don't hesitate to revisit these resources for additional explanations, examples, and insights that can support your case study work. Research websites. There are several reputable finance websites you can use for quick references or deeper dives into specific topics. Two examples listed here on the slide are one, netmba.com. This website offers clear and concise explanations of financial concepts, including different types of financial ratios. It can be a great resource to brush up on ratio definitions and how to apply them. Investopedia. Investopedia is another fantastic resource. Their university section provides detailed articles on various financial ratios, how they're calculated, and their relevance in financial analysis. Both of these websites provide accessible explanations that complement what we discuss in class, making them great supplemental materials for learning and applying financial concepts. Document your sources and use APA style. Whenever you research financial ratios or other concepts, it's crucial to document your sources accurately. Proper citation is not only a good academic practice, but also helps maintain the credibility of your analysis. Make sure to use APA style for all your citations. If you're unfamiliar with APA formatting, many resources online can guide you on how to properly cite web pages, textbooks, and other materials. These resources are meant to support your learning and analysis throughout this course. Make sure you utilize them effectively to deepen your understanding and to help build your research and analytical skills in finance. To improve our understanding of ratio analysis, it's important to recognize that the accuracy and value of these ratios are only as good as the underlying financial statements. Before we analyze any ratios, we must first understand the accounting policies that have shaped those financial statements. This means looking into how a company treats things such as goodwill, the intangible assets arising from acquisitions that may vary significantly between companies. Lease obligations. Different approaches to capitalizing leases can impact balance sheet figures and profitability ratios. Equity interests in subsidiaries. Companies may consolidate or report equity stakes differently, which can affect key ratios like debt to equity. A thorough understanding of these items will give you a clearer picture of a company's true financial position and help you interpret ratios more accurately. Also, be aware of missing data, as gaps in financial information can sometimes limit or mislead your analysis. How to evaluate a company's balance sheet. The link provided here takes you to an Investopedia.com article focused on breaking down a company's balance sheet, which is one of the most critical financial statements for ratio analysis. This resource explains what to look for, how assets and liabilities are presented, and how to assess a company's financial health from its balance sheet. Another Investopedia resource linked here is the Financial Statement Analysis Tutorial. This is an excellent guide for understanding how to analyze not just the balance sheet, but also the income statement and cash flow statement. It offers insights into how each statement connects and contributes to the financial ratios and metrics we use for evaluation. This slide outlines some fundamental concepts that are essential for understanding finance and investment. Let's break down each of the following points. Financial ratios. These are important tools used to evaluate a company's performance. They help compare various aspects of a company's financial health against its competitors as well as against industry benchmarks. Common ratios include profitability ratios, such as net profit margin, liquidity ratios like the current ratio, and leverage ratios such as debt to equity. By using these ratios, we gain insights into how well a company is operating, how efficiently it is utilizing its assets, and how it is managing its liabilities. Ratios allow for an apples-to-apples comparison across different companies regardless of their size. Stock price and cash flows. A company's stock price is not just a random figure. It's a reflection of the present value of expected future cash flows. Investors purchase stocks based on their expectations of a company's future profitability and its ability to generate cash. When these expectations are high, the stock price tends to rise. Essentially, the value of a stock is driven by what investors believe the company will earn in the future, discounted back to its present value. Therefore, changes in a company's performance, profitability, or future prospects can have a direct impact on its stock price. Higher dividends and stock prices. Higher dividends are often associated with higher stock prices. But why is this? It ties back to the concept of cash flows. Dividends represent a direct return of profit to shareholders, and when a company pays higher dividends, it signals confidence in its financial health and stability. This can make the stock more attractive to investors, driving demand and consequently the stock price higher. Keep in mind that dividends are not guaranteed. Companies decide when and how much to pay based on their financial situation and growth strategies. The key question posed on the slide, why is this true, encourages you to connect the relationship between stock prices and cash flows. If dividends are a form of cash flow to shareholders and stock prices reflect the present value of those expected cash flows, it makes sense that a stock with higher dividends would typically be valued more highly. When analyzing a pair of companies in your case study this week, the focus should not only be on numbers, but also on the qualitative factors that give context to these numbers. Let's break down the approach to effectively analyze and discuss each company pair. Qualitative features. Start by identifying and briefly discussing the qualitative aspects of each company. These can include the industry in which they operate, their business models, their market position or competitive advantage, and any external factors influencing their operations, such as regulatory environment or economic conditions. Understanding these qualitative factors helps frame the financial data. They tell a story about each company's operations, strategies, and overall market context, which is crucial when interpreting their financial ratios and performance. Expectations and conclusions. Next, use your research to form expectations. Before diving into the numbers, ask yourself, what performance trends do you expect to see given each company's characteristics? Also, how might their industry and business environment influence their financial ratios? Thirdly, what conclusions could be drawn from these expectations? Be sure to draw conclusions that link the qualitative features to the financial performance. Are the companies performing as expected based on their strategies and market conditions, or are there any surprises? This helps in making your analysis more insightful. Avoid simply reciting the numbers or the facts of the case. Focus on the meaning behind those numbers. It's crucial not to fall into the trap of simply presenting a mind-numbing recitation of the numbers. We can already see those figures in the case study. So instead, interpret those numbers. What do they mean for the company's operations and strategy? Tell the story behind the ratios. For example, if a company has a high inventory turnover ratio, what might that say about its sales efficiency or inventory management? This approach is about critical thinking and analysis. Use the qualitative features and the expectations you've set to give the financial data context and depth. This will make your presentation and analysis more compelling and insightful. After concluding your research, feel free to guess who the actual company names are. Also, from your classmates' descriptions, can you guess who their companies might be? Keep in mind, the names of the companies are not important. We are more concerned about the financial data, the ratios, and how to interpret them, right? We don't care who the companies are for this assignment. In fact, you don't even need to know who they are. The data is from actual companies, but again, we're not here to research what's currently going on with an actual company. We're only interested in the relative performance measures based upon the data provided. Remember, business finance is all about connecting the dots, how the numbers tell the story of a company's performance and strategic positioning. Your ability to critically analyze and interpret these financial indicators is a skill that will serve you well beyond this course. This brings us to the end of our session for now. I hope you have a much clearer understanding of the key concepts we've covered, including ratio analysis, interpreting financial statements, and drawing meaningful conclusions from company data. Of course, if you have any questions or need clarification, please don't hesitate to reach out. My contact details are on this slide for your convenience, as well as posted in numerous areas throughout the course. I look forward to our next live chat, where we will continue building on these concepts and diving deeper into the case studies. Thanks for your time and attention today, and I encourage you to keep engaging with the materials and practicing your analysis skills.